Good day, everyone, and welcome to the presentation. Today, we are discussing anti money laundering according to the Financial Intelligence Center Act. We'll discuss South African money laundering legislation and the implications for our accountable institutions in transacting with clients. So let's start with Unit 1. Unit 1 is based on the purpose of the various money laundering legislation applicable in South Africa. So, assessment criteria one states that the concepts of money laundering and unlawful activities are explained with examples. So, let's do activity one. Explain the concept of money laundering and give some examples. Acts now criminalized as money laundering have been closely associated with crime and criminals throughout history. It was natural that criminals fearful of the prosecution took steps to hide or disguise the true nature of the proceeds of their crimes. Ill-gotten gains such as proceeds of theft were incriminating by nature and had to be sold or changed to break the apparent linkages between the holder of the property and the crime. Obscuring the nature of ill-gotten gains also provided protection against possible forfeiture. Money laundering refers in general to any act that obscures the illicit nature of the existence, location, or application of proceeds of crime. The origin of the term is often traced back to the use of laundries as front businesses by American gangs in the 1920s and 1930s. You see what they did? They used to keep money, the dirty money that is in their washing machines and they will wash it and then try it there. This is a true story and it happened, it's a fact. But let's continue. Money laundering can take place in a myriad of ways. At an elemental level, a criminal might launder stolen money by purchasing a valuable item in one city and selling it at a later stage in another city. Cell phones, jewelry, and vehicles are popular choices, as is fixed property. The transaction rids the criminal of the hot money, making it more difficult to link him to the crime. Possession of the item and the subsequent sale also provides the necessary explanation for the clean cash later. Criminals with more funds to wash and criminals organizations whose activities generate large amounts of illicit funds cannot safely rely on one laundering transactions only. They usually require a more sophisticated money laundering scheme, which might utilize shell companies and perhaps an intricate web of international financial transactions, potentially involving cryptocurrencies. Internationally, financing of terrorism refers in general to the unlawful and intentional collection or provision of funds, whether directly or indirectly, with the intention that they should be used or knowing that they are to be used in whole or in part to commit an act that is regarded by the United Nations as a terrorist act or by a terrorist organization and individual terrorists. In the case where funds are intended to be used by a terrorist organization or individual terrorist, the act of collection or provision of funds would constitute the financing of terrorism, even without the state having to establish that the funds are used to carry out terrorist acts or are linked to a specific terrorist acts. This means that the collection or provision of funds for any activities, including the general upkeep of a terrorist organization or individual terrorist, is terrorist financing. Terrorists and their funders generally require anonymity and often use strategies that are like those employed by money launderers to hide their money flows. However, there are key differences between the two concepts, and may be sure that you know these key differences between terrorist financing and money laundering. Money laundering involves property that is tainted by its criminal origin, while financing of terrorism focuses on property that is tainted by its intended application. As funds that are used to finance terror are not necessarily proceeds of unlawful activities, the term reverse laundering is sometimes used in respect of the financing of terrorism. The legitimate origin of funds used for terrorist financing exacerbates the challenge to identify and track the financial support for terrorism. Examples of social benefits payment, students' loans, and even proceeds of government procurement contracts being used to fund terrorism have emerged. Let's look at activity 2. What are the stages in money laundering schemes? Identify them with examples of each. So, in many discussions of money laundering, three stages are generally distinguished in the money laundering processes. Those three stages are the first one being the placement stage, the second one, the layering stage, and the integration stage. As you can see in the picture there, it's a vicious circle. You put the placement, the layering, and the integration. Those are the three stages of money laundering. Let's have a look at them individually now. During the placement stage, the proceeds of crime enter the financial system. The purpose of the placement stage is to place the proceeds with one or more financial institution or institutions, which makes it possible to manipulate the proceeds by using the services which financial institutions offer to their customers. A criminal with a large cash amount in his possession often moves the money to another location where placement can take place with greater safety. Frequently, a large amount is split up into smaller amounts, which can then be deposited in different bank accounts without raising suspicion. This process is referred to as smurfing or structuring. Smurfing is often employed in countries where all transactions involving large amounts of cash must be reported. Another method of placing funds with financial institutions is using the services of professionals such as legal practitioners or accountants who offer the ability to pull funds or to accept and place funds to their clients. After placement of the money, the layering stage begins. Layering is aimed at separating the illicit proceeds from their criminal source. It usually entails a complex series of transactions which are solely aimed at blurring the trail of the money. In many instances, this series of transactions will include the movement of funds across different jurisdictions. The following transactions are examples of layering: drawing money from an account at one bank, splitting the amount and depositing it into three different accounts at three other banks, purchasing property and selling it soon afterwards, depositing money into a trust account of an attorney and then requesting it to be repaid or paid into other personal accounts. Remember, the aim here is to separate the illicit proceeds from their criminal source. The last stage involves the integration of all the funds. Now the funds are in the system. The original amount minus the cost of the laundering process is amassed and placed under the control of the criminal as apparently legitimate business funds. The costs include bank costs, taxes, and any commission payable on the transactions. Let's look at activity 1. Various acts were created to battle money laundering. Please identify and give a brief explanation of each one below. So now at this stage, we know that there are three stages in money laundering. Now let's continue to look at the legislation that is created to battle money laundering. The first one is the FICA, Financial Intelligence Center Act 28 of 2001. The Financial Intelligence Center Act as amended by the Financial Intelligence Center Amendment Act 1 of 2017, contains the control measures for preventing money laundering and financing of terrorist and related activities, as well as the implementation of financial sanctions. The Act prescribed the control measures that must be complied with by accountable institutions and, in certain circumstances, business owners, managers, and employees to assist in the detection, prevention, and investigation of money laundering and terrorist financing activities. Some of the objectives of the Financial Intelligence Center Act are to combat money laundering activities and the financing of terrorist and related activities, to impose specific duties on institutions and other persons who might be used for money laundering purposes and the financing of terrorist and related activities. Still continuing on the objectives of the FICA, to provide for customer due diligence measures, including beneficial ownership and persons in prominent positions, to provide for a risk-based approach to client identification and verification, to provide for the implementation and monitoring of risk management and compliance programs, to provide for governance and training related to money laundering and counter-terrorist financing, to provide for the registration of accountable and reporting institutions, to provide for administrative sanctions that may be imposed by the center and supervisory bodies, and to provide the center and supervisory bodies with powers to conduct inspections. An accountable institution, as per Schedule 1 of the FIC Act, includes an FSP who is authorized by the FIRES Act to provide advice and/or intermediary services in respect of the investment of any financial product, but excluding a short-term insurance contract and a health service benefit provided by a medical scheme. The primary or main purpose of FICA is requiring a long list of accountable institutions defined in the Act to follow. Specific procedures: report suspicious activities or report unusual transactions relating to combating money laundering. The essential characteristics of an accountable institution is its possible use for money laundering. Accountable institutions themselves are not necessarily statutory bodies, but include people and institutions that can be used for money laundering purposes. I hope we are still together up to so far. So, as an accountable institution, in terms of Schedule 1 of the Act, examples of accountable institutions include banks and corporate banks, estate agent, excluding estate agents who render services to body corporates or sectional title schemes and share block companies, attorneys, trust companies, collective investment schemes, long-term insurance companies, including an insurance broker, and a representative of an insurer. The Act applies to a natural and legal person defined as an accountable institution in terms of Schedule 1 of the Act. So examples of accountable institution include all institutions that sell items valued at 100,000 or more, crypto asset service providers, high value goods dealers, the South African mint companies, payment clearing operators. The Financial Intelligence Center, that's the FIC. The Financial Intelligence Center was established and enabled by the provisions of the Financial Intelligence Center Act. The center plays a central role for all matters concerning the laundering of money and financing of terror in South Africa. The principal objectives of the center are to assist in identifying the proceeds of unlawful activities, the combating of money laundering activities, and the financing of terrorist and related activities. It is also responsible for the implementation of financial sanctions in accordance with the resolution adopted by the Security Council of the United Nations. The other objectives of the center are to make information collected by it available to the following bodies: investigating authorities, the intelligence services, National Prosecuting Authority, which is the NPA, the South African Revenue Services, SARS, the Independent Police Investigative Directorate, IPID, the Intelligence Division of the National Defense Force, Special Investigating of Unit, Public Protector, an investigative division in an organ of state, supervisory body to facilitate the administration and enforcement of the laws of the Republic, to exchange information with similar bodies in other countries regarding money laundering activities, the financing of terrorists and related activities, and other similar offenses. And overall, the center is expected to supervise and enforce compliance with the Act or any directive made in terms of the Act, or to facilitate effective supervision and enforcement by supervisory bodies. Supervisory bodies. The role of a supervisory body is to assist the Financial Intelligence Center in carrying out its objectives. The supervisory bodies are Financial Sector Conduct Authority, South African Reserve Bank, Estate Agency Affairs Board, Independent Regulatory Board for Auditors, National Gambling Board, Law Societies, Provincial Licensing Authority. To achieve the objectives, the center must process, analyze, and interpret information disclosed to it and obtained in terms of the Act. Where appropriate, initiate analysis based on information in its possession or information received other than by means of reports made to by accountable institutions in respect of their reporting duties. Monitor and provide guidance to accountable institutions, supervisory bodies, and other persons regarding the performance and compliance by them of their duties and obligations in terms of the Act or any directive made in terms of the Act. Provide information and guidance to accountable institutions to assist them in meeting requirements to freeze property and transactions in line with resolution adopted by the Security Council of the United Nations. Retain any processed, analyzed, and interpreted information in the manner and for the prescribed period required by the Act. Annually review the implementation of the Act and submit a report thereon to the Minister. Implement a registration system in respect of all accountable institutions and reporting institutions, and supervise and enforce compliance with the Act or any directive made in terms of the Act by accountable institutions, reporting institutions, and other persons to whom the provisions of the Act apply. We are still on the legislation applicable in South Africa to combat money laundering. So the next legislation is Proceeds of Crime Act, which is the POCA Act of 121 of 1998. So in 1998, the South African government decided to take firm action against organized crime and commissioned the Agent Drafting of a Prevention of Organized Crime Act. The resultant draft legislation created specific offenses in respect of racketeering and participation in criminal gang activities. Provision was also made for a civil forfeiture procedure in respect of property involved in a pattern of illegal conduct, as well as property constituting the proceeds of unlawful activities. The racketeering provisions were based on the RICO legislation of the United States. This act broadened the scope of the money laundering provisions to the proceeds of any type of offense. The main objectives of POCA are criminalizes certain activities that are linked to a pattern of racketeering and creates offenses relating to activities of criminal gangs, criminalizes money laundering in general, and creates several severe offenses in respect of the laundering of the proceeds of a pattern of racketeering activity. contains mechanism for criminal confiscation of proceeds of crime and for civil forfeiture of proceeds and instrumentalities of offenses, and allows the National Director of Public Prosecutions to obtain information for purposes of an investigation under the Act from any statutory bodies and creates mechanisms for cooperation between the investigators and the Commissioner of the South African Revenue Services. POCA also created a general obligation for businesses to report certain suspicious transactions. However, this provision was amended in 1999 and later repealed when a broader duty to report suspicious and unusual transactions under FICA came into effect on 3rd of February 2003. Proceeds of Crime Act repealed the Proceeds of Crime Act of 76 of 1996 and the money laundering provisions of the Drugs and Drug Trafficking Act 140 of 1992 for a relatively short period of time. The money laundering provisions were therefore consolidated in POCA. POCA introduced several significant changes to the money laundering regime. For instance, POCA provides explicitly that laundering offenses can be committed by one who negligently fails to identify the true nature of the illicit property. It was uncertain whether a money laundering offense under the Proceeds of Crime Act could be committed negligently. The definition of proceeds of unlawful activities is broader than similar definitions in the Drugs and Drug Trafficking Act and the Proceeds of Crime Act. Persons who had to report suspicious transactions were allowed by POCA to continue with those transactions if they took reasonable steps to comply with their reporting obligations. As a result of the extreme pressure under which the new act was drafted and redrafted, it had a number of drafting flaws. Amendments to address these flaws were affected by the Prevention of Organized Crime Amendment Act 24 of 1999. The Amendment Act also introduced new provisions, including the following amendments to the money laundering provisions. The duty to report suspicious transactions was broadened to managers and employees of businesses undertakings, and the Amendment Act inserted a new Section 7A, since amended by FICA, that allowed persons who reported a suspicion in terms of POCA to raise that fact as a defense if they are charged with negligently committing certain money laundering offenses. The original Prevention of Organized Crime Bill contained such a defense, but it did not survive the parliamentary passage of POCA. The other legislation applicable in South Africa in combating money laundering is POC-DATARA, Protection of Constitutional Democracy Against Terrorist and Related Activities Act 33 of 2004. In May 2005, the POC-DATARA Act came into effect. The main objective of this act was to introduce an obligation to report certain offenses linked to terrorist activities, including terrorist financing. The act provides for the offense of terrorism and other offenses associated or connected with terrorist activities. Amongst its other aims and objectives, the Act also prescribed measures to prevent and combat the financing of terrorist and related activities. Section 1 of the Act defines what activities fall within the ambit of terrorist activity and terrorist-related activities. Terrorist activities has three main elements, namely a specified act or omission involving an element of violence or disruption. The second one, the act must be intended or capable of being reasonably regarded as intended to threaten the national security or territorial integrity of South Africa, to intimidate any segment of the public, or to unduly compel specific persons or institutions to act in a particular manner. And lastly, the act must be committed directly or indirectly, in whole or in part, to further an individual or collective political, religious, ideological, or philosophical motive, objectives, or cause. There are 8 types of acts of violence and or disruption listed in the definition of terrorist activity as acts of terror and or terrorist related activities, whether committed in South Africa or elsewhere. Examples of these acts include the systematic, repeated, or arbitrary use of violence by any means or method, the system, repeated, or arbitrary release of hazardous substances into any part of the environment, their distribution or the exposure of any part of the public to such a substance, or which endangers the life or violates the physical integrity or physical freedom of or causes serious bodily injury to or the death of any person or any number of persons, etc. This means and methods of how the acts are committed are irrelevant. Sorry, the means and method of how the acts are committed are irrelevant. The act must have intended or reasonably be regarded as intended to achieve one of the following: threaten the unity and territorial integrity of South Africa, cause feelings of insecurity, induce or spread feelings of terror, panic or fear in the population, or compel, intimidate, force, induce, or cause a person or persons, natural or otherwise, to do or abstain or refrain from doing any act, or to adopt or abandon a particular standpoint, or to act in accordance with certain principles. The above intentions exclude industrial action or any struggle in which people are furthering their human rights. The terrorist financing provisions of POGDADARA must be read in conjunction with the relevant provisions of POCA, FICA, and PRECA. PRECA is the Prevention and Combating of Corrupt Activities Act 12 of 2004. POGDARADA amended FICA and POCA to ensure that these laws support not only the combating of organized crime and money laundering, but also the combating of terrorism in general and the financing of terrorist activities. As a result of this interrelationship, POGDARA definitions of key terms such as property are like the FICA and POCA definitions of those items. I believe that we are still together up to this far. Let's continue. POGDATARA also gives the same content to the concepts of knowledge and negligent ignorance as is described to them in the POCA and FICA. POGDATARA creates its own reporting obligations, but simultaneously amended FICA by inserting a new reporting provision regarding property associated with terrorist and related activities, and by extending the Section 29 reporting obligation under FICA to transactions that are known or suspected to be linked to terrorist financing. The Financial Action Task Force, FATF. The FATF is an intergovernmental body that sets standards, develops and promotes effective implementation of legal, regulatory, and operational measures for combating money laundering, terrorist financing, and the financing of proliferation and other related threats to the integrity of the international financial system. They focus exclusively on combating money laundering and funding of terrorism. The Financial Action Task Force is essentially a policy-making and standard-setting body that promotes policies to combat money laundering and terror financing. Within that framework, it also supports the combating of other severe offenses, for instance, corruption, and it supports the suppression of the financing of weapons of mass destruction. A financial action task force was established by the G7 summit in Paris in July 1989 to examine measures to combat money laundering. In 1990, the Financial Action Task Force formulated the so-called 40 recommendations to address this problem. The recommendations were accepted by the G7 summit in Houston in July 1990. At that meeting, the G7 reconvened the Financial Action Task Force for a further year to assess and facilitate the implementation of the recommendations and to complement them where appropriate. In 1991, it was decided to continue the Financial Action Task Force for another 5 years, subject to a mid-term progress review. Since that date, the lifespan of the Financial Action Task Force has repeatedly been extended through political decisions by ministers of its member jurisdiction for similarly limited periods. In 2004, its mandate was renewed until 2012, and during this period, its focus broadened to anti-corruption and proliferation financing too. The Financial Action Task Force's mandate was renewed again in 2012, this time until 2020. The current membership of the Financial Action Task Force comprises 35 jurisdictions and two regional organizations, that is the European Commission and the Gulf Cooperation Council. South Africa joined the Financial Action Task Force in June 2003. The role of the Financial Action Task Force includes monitoring the progress that members make in implementing measures to combat laundering and the financing of terrorism, reviewing techniques to launder money and finance terrorism, and considers countermeasures, and globally promoting the adoption and implementation of measures to combat money laundering and the financing of terrorism. Although member countries have different legal and financial systems, the FATF recommendation sets the international standard regarding implementation and monitoring a counter money laundering framework. The following essential measures, as prescribed by the Financial Action Task Force recommendations, must be in place in each of the member countries. Identify risk and develop policies and domestic coordination. Pursue money laundering, terrorist financing, and the financing of the weapon of mass destruction. Apply preventative measures for the financial sector and other designated sector. Establish powers and responsibilities for the competent authorities, for example, investigative, law enforcement and supervisory authorities, and other institutional measures. Enhance the transparency and availability of beneficial ownership of information of legal persons and arrangements, and facilitate international cooperation. As South Africa is currently a member of Financial Action Task Force, both the money laundering and terrorist financing legislation in this country is based on the guidelines spelled out in the Financial Action Task Force recommendations. Let's look at assessment criteria 3. The statutory bodies created to support the money laundering legislation are identified with reference to the functions of the different role players. So let's look at activity 1. It says identify the various supervisory bodies created to support the money laundering legislation. Identify 5. The role of a supervisory body is to assist the Financial Intelligence Center in making sure that accountable institutions that fall within their jurisdiction comply with the requirements of the FICA Act. The supervisory bodies are Financial Sector Conduct Authority, South African Reserve Bank, Estate Agency Affair Board, Independent Regulatory Board for Auditors, National Gambling Board, Law Societies, Provincial Licensing Authority. At this time, at this moment, I would like us to take a break and then recap. Let's just recap what we have been doing. Like we have been dealing with the legislation that is there. to combat money laundering, which is one of the legislations that we did was the FICA, POCA, POCTARADA, and the PRICA. And we also learned about the 3 stages of money laundering in the beginning of the chapter. Let's just have a break and we'll continue afterwards.